We'll be looking at capital allowances. I don't know, we might ask. Those guys are not good. Let me just check. Capital? Very, 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 very good. So guys, let's look at some capital allowance. Capital allowance as our topic of discussion. Can you put us on the time and listen to the chairman of this class before we define we look at what capital allowance is all about, the first thing we need to understand is, first of all, we need to understand what capital allowance is all about. We should also be able to understand the types of capital allowance that we have. Then also have to identify assets qualifying for different types of capital allowances, and also apply appropriate restrictions on investment, initial and annual allowances. And we should also be able to compute capital allowances. Now, in accounting, this is what happens. When we are producing a financial statement, did I teach you accounting one? Did I teach you accounting one? Accounting two? We've done accounting two also. Okay. So, in accounting, what is this going to happen? When you have an asset, every year, the asset has to be what? Depreciated. And depreciation is a cost. Depreciation reduces what we call value of asset, yes. At the same time, it's what? Expense, isn't it? It reduces the net profit. Are we together? So when you have operating expenses or additional expenses, one of the expenses will be what? Depreciation. And when you go to the balances, the value of the asset will be reduced by what? Depreciation. Understood? Decay. Yeah, so depreciation has to be done, and this one is in line with what we call the matching concept. Have you done accounting concept? Have you done accounting concept? Do you know what the matching concept is all about? Yeah, so depreciation is done in line with that concept. Are you doing accounting as well? Accounting too?
Yes.
Okay, what topic are you discussing now? Okay. What about balance?
Yes, correct.
But that is the balance. Who's your name?
Family.
What's your name?
James.
Oh, I'm James. Mulima. So depreciation. So in terms of tax, in terms of accounting, is acceptable expenditure. You have to depreciate your assets, and that has to be done without any extension. Are we together? But when it comes to taxes, depreciation is not an allowable expense for tax purposes. So the MIA will not accept depreciation as an expense. Will not allow depreciation to reduce the revenue for that financial year. So, because to them, that one is not an allowable expenditure. Are we together? So, it has to be added back. Am I making myself clear? So, you don't sit here. Here we don't sit. As long as you're here, not sitting. So let's look at capital allowance provisions. Or provision, capital allowance provision. Does it sound right? Capital allowance comes in. Okay, so because depreciation is not an acceptable or it's not an allowable expense for tax purposes, capital allowances comes in instead of what? Depreciation. However, so the MIA, instead of depreciating assets, they charge what you call capital allowance. However, so capital allowance comes in place of what? Depreciation. If you prepare financial statements, many of you can prepare, so no, that depreciation, when you can prepare, you do that, you send it to the MIA, and the MIA will add back depreciation. They will say it's not an expense. So if depreciation is 1 million, and your net profit is around 4 million, the MIA will add it back. The net profit will come back to 5 million, isn't it? Because depreciation is not allowable expense for tax purposes. But instead of depreciation, we're supposed to bring in what we call capital allowance. Are we together? Very good. Under section 53, the taxpayer is allowed section 63 of Taxation Act. Section 53 of Taxation Act. Section 33. Section 33. Section 33. Section 33 of the Taxation Act allows the taxpayer to deduct capital allowances. Are we together? So it allows you to deduct capital allowances in place of what? Depreciation. Okay. In accounting, depreciation is acceptable. Do you know that? But we have concepts, we have the standard that allows us to charge depreciation. Because we also have the going concern, which consider the business as a going concern. So since the business is a going concern, there is need for replacement. So if you buy another vehicle today, after 10 years you have to replace it. How do you replace it? You need to save some money. After saving some money, you just have to add top up per bit and replace that motor vehicle. How do you save money? By charging depreciation. Because in actual sense, depreciation doesn't go anywhere. Where does that money go? Landlord is not like the other landlord, isn't it? Fuel, we know fuel or venom. Allowances will pay people. But where does depreciation go? Have you ever asked yourself question after charging depreciation? Where does it go? Who benefits? Where does that money depreciation go? It doesn't go anywhere either. It's still in the business. So it's one way of saving our money. So that we have a replacement of that asset in the near future. So that the business continues to operate as a going one concern. How is it? So we are allowed to charge capital allowance under section 33. Now, let's go to types of capital allowances. There are three types of capital allowances. There are three types of capital allowances, namely investment. There's investment, initial, and annual. Investment, initial, and annual. Investment, initial, and annual. Investment and initial are first year allowances. Investment and initial are first year allowances, mutually exclusive. The mutually what? Exclusive. What do you mean by mutually exclusive? That means where investment allowance is given, initial allowance are not what? Allowed on the same asset. That means you cannot charge investment and initial on the same what? Asset. It's either you charge investment allowance or initial allowance. You charge them on the first year. There are allowances for the first year of investment or procuring of that particular asset. So I'm saying they are mutually exclusive. So both initial and investment allowance are claimed in the year in which asset is acquired or brought into use. So they are claimed in the year the asset. In the year which the asset is acquired and brought into use. What means is that why do you say these allowances are charged on the first year? So initial investment are charged on the first year. That's to say, the year when that asset is what? Bought or purchased. Or the year when the asset is brought into use. Maybe you're producing it. So the year that you start using it is when you charge that particular those two allowances. But many annual allowances are given to the taxpayer in respect of all assets that are used by taxpayer on the last day of the year of assessment. So annual allowances are charged every year on each and every asset, regardless of whether initial or what, investment or what, as well charged. So in this case, you need to look at these assets that will be charged at all times. Understood? investment allowance or investment allowances. So, how many allowances we have? Tax allowances? How are they different? That's the one. That one here? Okay, good. Dutego, Mayamba, okay, man. Okay. So, investment allowances. So these are available to taxpayers who are manufacturers. These are available to taxpayers who is also a manufacturer. Yeah. So investments that are available, so you can charge them, available to a taxpayer who is also a manufacturer. Who is a manufacturer? How do you define manufacturer? A manufacturer is the owner of business. Okay. Manufacturer, manufacturer is the owner of the business carried on in industrial buildings. Owner of the business carried on industrial buildings, or the owner of the plantation producing tea, coffee, tobacco, sugar, cocoa, or such other crop as the minister may approve. So a manufacturer is a business person. This person can have buildings in an industrial area. We'll define what industrial area is. Also can have a farm producing coffee, tea, and what have you, any crop as the minister may approve. That means you cannot charge investment allowance or on something that has not been approved by us. Means, isn't it? If you have a farm, if the farm is approved, then the industry allowance is doing what? Charge. Are we together? So, where do we claim industrial allowances? So investment allowances. So investment allowances are claimable. You know what's claimable? How do you like claimable? What's claimable for you? Claimable. So they are claimable on industrial buildings. Okay. So you can charge on industrial buildings, plants, and machinery. Okay. Plants and what? Machinery, which are in use by taxpayer during the year of assessment, and used by taxpayer in the process of manufacture for purpose of manufacturing. So, you can claim on industrial buildings, plants and equipment, or plants and what? Machinery, which are used by taxpayer during the year of assessment and used by taxpayer in the process of manufacture for purpose of what? Manufacturing. Okay. So, what we need to say here is that you are a manufacturer, and in the course of manufacturing your product, you are using machinery or you have a plant. Okay, that you use to process your product, that you use to have another way to process, the non-material final product, those come under investment what? Allowances. You have invested your money in acquiring buildings, plants, and what? Machinery. So the rates are as follows. What are the rates? The rates of what? Charging it. The rates are as follows. One. The rates are as follows. Number one, we're saying 100% of the cost of a new and unused industrial building. And what?
New.
And unused industrial buildings and plant and machinery. So what means is to be started? When we are claiming capital allowance on investments, if a building is new or is unused, then it's 100%. What it means is we are going to claim or charge capital allowance on the total price or the total cost of that building. It doesn't include if the building is worth 50 million, then 50 million is the capital allowance. See more than? But 50 million is the 100% of the price on which we're going to charge capital allowance. Understood? Are we together?
Yeah.
Yes.
So if the building is new, or in other words, a plant and machinery is new or is unused, then the 100% of the cost will be used to charge that. We'll charge capital allowance on the total, 100% of the cost. Number two, 40% of used industrial or plant and machinery. Anything? So 40%, that is to say, if we are building, if you have just built a building, industrial building, and it has cost the business around or about 40 million, what it means is, first year, we're going to charge how much? 100%. What they mean, we charge, we're going to look at the rate, but now we're just trying to determine the taxable income, the amount, the claimable amount. Okay. So, in this case, they're going to charge the total. If the building is used, it's not a new building, then then what? Capital allowance will be charged on 40%. You only take 40% of that building and charge what? Capital?
Yes.
Mona. Are you Mona Lisa or just Mona? Or Monopoly?
Mona.
What does Mona mean?
Art design.
Huh?
Art design.
Art design. What language is that? What language? Swahili?
Asian.
But Asian language.
Asian.
So Mona Lisa is Swahili. It's the same. Vero Mona Lisa. But you're just Mona. Okay, so for the purposes of investment analysis, plant and machinery does not include motor vehicles. For the purpose of investment analysis, plant and machinery does not include motor vehicles intended or adapted for use or capable of being used on roads. Now let's define an industrial building. What is the definition of that, or the meaning or the definition of industrial building? Then I put the investment itself what? Industrial building or industrial building and what? Plant and what? Machinery. So what do we mean by industrial building? Industrial building is a building which is used for making of a part or full article. A building that is used for making part or full article, isn't it? Number two, the subjection of goods, used for the subjection of goods to any process, including breaking up and demolition of. So if you have a building that you're using it for subjection of goods to any process, if you are trying, maybe you have a building that you use to break for car breaking, for this, you have a car breaking business, and then if you have a building that you're using to break those cars or to demolish those cars into other products, that one qualifies as what? Industrial building. For the adaptation for sale of any article, if you want to use that for the sale of any article, it becomes an industrial building. If a building is used for generation of power, understood? Generation of what?
Wow.
You have a mini grid, you have using for electricity, generating electricity, and what have you. Then we transport the dock, inland navigation, water refrigeration, electricity. have a hotel, it's an industrial building. A processing and distribution of fish, including shellfish, it's an industrial building. Any activity which the minister declares in writing to be making an important contribution to national development is an industrial building. So I say exclusions from definition of an industrial building. From the definition, there are some exclusions or some things that are not confined to an industrial building. One, we're looking at dwelling houses. A dwelling house is not an industrial building. Retail shops are not what? Industrial building. Showrooms, wanasema freemaisure, those are not industrial buildings. Storehouses and offices these do not qualify to be an industrial building. Okay, so these are exclusions. They're excluded in the definition of industrial building. So they're excluded if you have a dwelling house, retail shops, showrooms, they don't qualify to be industrial building. Hence, capital house cannot be what? Child. Let's look at staff buildings, staff housing, meaning of a staff housing. Staff building So these are houses that are erected for occupation by employees engaged in the business or farming operations of the manufacturer or farmer respectively. So if you're a farmer, you have built some houses for workers at the farm. Those are staff what? Houses. Okay. Staff houses do not qualify for investment allowances, but for initial and annual allowances. So staff houses, you may have staff houses, but they don't qualify for what? Investment allowances. Likewise, retail shop and what have you. Where staff houses is occupied by an employee described below, the capital allowances have been restricted to 1/30 of such allowances. If they have all houses are occupied by an employee, the capital allowances are restricted to what? 1/3 of such allowance. Please, think about what you're going to do. So, the father, the best amount of money. Just to wake up. So, when you're not so, an employee whose time is not wholly occupied in the service of the company, who is able to direct or indirectly to control more than 5% voting rights, attaching to all classes of shares of the company. Now, I want to look at another scenario where you have a building, and that building has both components. The building has both industrial and the non-industrial area. Okay. There's a building, but there's what? Components. So how do you demarcate? Because if it's not a component, yeah, from a showroom, from a another side of my example, car braking, that means there are two components, and those components are one, what we can have, industrial component and non-industrial component, isn't it? So, how do we deal with such situation? Where the building has both industrial and non-industrial elements, and the capital expenditure which has been incurred on the construction of non-industrial elements is not more than 150, which is 20%. It's not more than 20% of the total capital expenditure which has been incurred on construction, the whole building, and every part thereof shall be treated as industrial building. So, when you have a building, you incur what we call capital expenditure. Capital
Expenditure.
So, when that capital expenditure that you have spent on capital expenditure on non-industrial building, for it to qualify to be industrial building, it has to be more than what? 20%, isn't it? If it's less than 20%, then that one doesn't qualify to be an industrial. So if the cost of an industrial building is less than 20, does not exceed 1/6 or in other words 20% of the total capital expenditure, then that one doesn't qualify to be what? For example, on this people, for example, on this people, open the example, page 63, among provided for example. Can we have a look at that example, please? Understood? One example. Okay. Open the example. Wait. However, a capital building with offices cost 100,000 to be 100 million constructed. How much of the cost qualifies for capital allowances is the cost of constructing the part which is used as offices? We have office here, another by construct 18. Next 18 years, the person is then the handle. So 18 is above what? 18 more 100 is about what? 8. Which is about 80%. So, how did you find it? 18 over 100 times
100,000.
Are you sure? I'm trying to subtract issues. So, 18% is below us. The requirement
Yes.
was for it to qualify to be capital allowance, the cost has to be more than what?
50%.
This one is low. Now, what about the price? It's about 500. So that one qualifies. So if the building was about to qualify to capital allowance, so we charge it as it is. Any questions? What is it that I'm waiting for? Really?